Starting off with some bad news, though, some dismal numbers from ISM on manufacturing, the lowest since the Great Recession ended in 2009. New orders and production also very low. Does that shake your confidence in the durability of the expansion at all?
No, it doesn't. It doesn't shake my confidence. I guess I'm a little surprised by the weak number. It had been weak and then it ticked up. I think that manufacturing has been struggling. It's definitely been contracting recently. I think the trade policy uncertainty has been part of that. The GM strike was part of that, but that's over. So it is a bit surprising. I think one thing that's been good for the economy, though, is with GDP growth, 2 and above. I'm looking for 2 to 2.25% in 2020, and a strong labor market supporting the consumer. I think we found that the economy can continue to grow, even when manufacturing is contracting just a little bit. So, I'm hopeful that we've got a very resilient economy at the moment.
Why is manufacturing contracting? Is this a self-inflicted trade war wound?
Well, I mean, if you go down individual, segments, I mean, obviously the auto industry has, plateaued the previous year, and it's been a little bit softer. You had the GM strike. You had that affected suppliers eventually because of the length of that strike. I think the trade tariffs on agriculture has had an effect. We haven't exported as many soybeans and pork as we had before, so the farmers are struggling. They're not buying as many heavy equipment pieces like they normally do at this point, so that's been a problem. And I think that not knowing exactly where your supply chains might lie on productively on either side of the border when you're uncertain about tariffs and things like that, there's been a lot of uncertainty, so businesses have been slow to continue their investment, and I think all of that dampens manufacturing.
This isn't Twitter, so I don't need your way too early hot take on Iran, but let me ask you this. How fragile is the recovery, the expansion at this point in terms of confidence? Business confidence is low already. If something were to happen with Iran, does that put the expansion in jeopardy?
I think the fundamentals have been pretty good. I think they've been quite good. I think the labor market's been very strong. The unemployment rate's 3.5%. 3.5%, really low. We brought a lot of people have been brought into the labor market who didn't have as strong an attachment to the labor market in previous years. They're enjoying the benefits, income growth that's fueling stronger, robust consumption at the moment. I think businesses have been a little bit wary because of uncertainties, but the president and China, the president says he's going to sign phase 1 of a trade agreement in January. So that I think people are optimistic about the setting for 2020 in terms of the international situation. Now the current overnight events in Iraq, I think, are certainly a question mark, and oil prices are up a little bit. But I think we've got a pretty good, robust, resilient economy that's growing just a little bit above trend. It's been a very long expansion, but it's been a durable one.
Oil prices a threat at all, do you think?
Well, oil prices, in general, they harm consumers. We actually export more oil now, so it's more neutral than it used to be. But that's not a positive, I would say.
You see us as having a basically 2% economy at this point, yet unemployment is near 50-year lows. So is that really telling us that we've just had a very long expansion and that's why more people are getting jobs? Or is it any kind of sign of strength for the economy going forward?
Well, I think growth, sort of decelerating towards trend growth. I put trend growth at 1.75%, so 2.25 is above trend, maybe 2.5%, depending on how things might play out. So I think that's good. We have had a long expansion, but I think the labor market, the unemployment rate going to 3.5%, more people coming into the labor force in the face of declining labor force participation rate trends due to demographics. I think that's been a good thing, and I think it's a good signal for the future when more people who previously didn't have a strong attachment to the labor force are getting jobs, being able to move to other jobs, and I think structurally that helps. And so I think that the fundamentals for the economy are good. It's been a long recovery. It's come from a very low point after the great financial crisis and the Great Recession, and so it's been a good run, and I'm looking forward to continued growth.
After 11 years of expansion, everybody's looking under rocks for the reason it's going to end. What do you worry about?
What do I worry about? It's easy. There's always risks. Obviously, international events are something that concern you. I think that inflation has been very low. I think that at this point in the cycle, we really need to get inflation up, to 2% and above 2% somewhat. We've said for quite a long time that our objective is 2%. It's symmetric, so we should be above 2% for some period of time. We've been below it for quite some time, and I think that in that environment, there's no reason to be concerned about low unemployment rates. I think the strong labor market is definitely an attribute, and we just need to keep focusing on getting inflation up. So I think the current setting of monetary policy is accommodative. I think it's supportive of all of this, and I think that it also has a bit of risk management positioning in there, so that if we face a few more obstacles over the next 6 months or a year, policy is accommodative, and we're well positioned to respond as necessary.
What's your best guess as to why inflation doesn't rise?
It's a great question. I think that the lower growth rates, trend growth rates that we've been facing have been quite a puzzle for monetary economists. I think that for quite some time, central banks have been thinking that interest rates are very low and they should be rising up naturally to something more neutral. I think judging how low neutral policy rates really are has been difficult for everyone. And so looking back on it, I thought that our rate increases in the past were well justified. I thought that we were still accommodative even before we decided to pause and then reduce interest rates. But coming up with a firm, accurate judgment on what neutral is and how much accommodation is in place is very difficult. And so I think that we would have been well served if we had been a little more conservative and not raise rates as much. I don't think it was a mistake, but it was a misunderstanding.
Well, if you weren't able to get inflation up as unemployment fell, what makes you think you can do it now?
Well, I think we need to maintain an accommodative stance is what this really tells us, and we need to focus on getting inflation up. I don't think we should be overly focused on the unemployment rate being low and, isn't that a concern? I think it's a good thing. I think it's consistent with a strong economy. I think that if there are financial instability concerns that you might be worried about because of low interest rates for a long period of time, you need to make a judgment as to what neutral rates really are and whether or not we've got the appropriate regulatory environment in place. I think we do. I think that after Dodd-Frank, we've got banks with more and better capital. I think that the Board of Governors and other federal agencies have been looking at whether or not there are ways to make modest adjustments so that we can continue to expand credit intermediation in a productive fashion to keep the economy going in a natural way. I think those have been good actions, and so I think we're well positioned.
Well, it brings us to the policy review. You're about a year into it. Maybe June is when roughly the chairman has suggested we'll get some results from it. Where do you think it ends up?
That's a great question. We've had a lot of good discussions. I think that we've benefited by focusing on, what do we really mean when we say maximum employment? How should we be thinking about unemployment rates, how people are benefiting in a strong labor environment? Is that something that we need to push against if we're concerned about inflationary pressures, but we haven't seen inflationary pressures? And so I think we need to clarify what we mean by symmetric inflation objective. We've been underrunning our 2% objective for, pretty much as long as we've announced that 2% was our objective back in January 2012. So I think we need to overshoot. I think we need to not be concerned about inflation, even if it rises up to 2.5% on a sustained basis. I think we need a framework that acknowledges what is acceptable in a much more explicit fashion. I think there's a bit too much artfulness to the way it's described now.
Well, it sounds like you're kind of with the majority of the committee that would probably do something with inflation averaging, one of the ideas for doing something like that. Would you agree? And what about the idea of changing the target to a range?
So I think these are all options that, we've discussed a little bit. We need to make some judgments about what is most effective. I think that coming up with a pretty clear explanation of what we mean by symmetry is very important. If a range is helpful for that and we can articulate how we would respond to different inflation settings within the range, I think that's what's really important. And averaging could be a component of that, but I think at some point you need to be able to explain to the public why you're comfortable with inflation at 2.25% to 2.5% when you say that 2% is your objective. We seem to be able to explain that we're comfortable with 1.5% inflation as long as we're aimed upwards. I think we need to be a little more clear about that.
One of the other questions that overhangs the Fed this year is what tools do you have for the next recession when it does come with interest rates all you got about 150 basis points on the short end, and maybe another 30 on the long end, even if you did QE.
Yep.
So what do you do? Yield curve control, maybe?
Well, I think that the now standard tools would obviously come into play. Lower interest rates for a longer period of time, providing some type of forward guidance on what the circumstances would be for explaining why you're in that situation as long as you are supporting the economy. I think one way or another, all of the tools and how you use them need to provide confidence to the American public that you're going to do everything that is necessary to get the economy going again and inflation up to your objective. And so whatever additional tools provide that confidence, I think, is really important. I think that a full-throated endorsement of a symmetric 2% inflation objective is a part of that, indicating that we need to get inflation up to 2% as quickly as we can if it's been underrunning at that in the face of a downturn and a very slow recovery. And then explaining why it's perfectly fine to go above 2% in the pursuit of a symmetric 2% inflation objective. I think that's a big part of it.
Low rates, low growth, low inflation. Alvin Hansen called that secular stagnation. Are you happy with where the economy is? Is this about the best we can do?
Well, I do think that you're onto something with this. It's certainly been the case that with low real equilibrium interest rates and fiscal policy has not really helped out very much in terms of adding aggregate demand. I think that the first fiscal stimulus in 2009 was certainly helpful, but it could have been larger. I think there's a tremendous number of fiscal projects that probably need to be undertaken over the next 20 and 30 years. Infrastructure improvement, just driving around highways, you sort of understand this, and going under and over bridges and underpasses and things like that. Why not have a plan so that we, have that type of fiscal support in place and certainly ready when you need more of it to expand that. So I think that the fiscal environment is an important part of that. The international environment's an important part too. When the entire world economy is growing strongly, then that benefits us as well in terms of interest rate policy. So there's a lot in play, and I think we need to be aware of it.